section will be in financial literacy and building capital. So I think the first major pill to swallow is, oftentimes when it comes to governments are spending very irresponsibly, especially in modern economics. They spend much more irresponsibly than we do, and they expect us to be more responsible as it pertains to personal finance. For example, the age-old adage of government and fiscal policy is thinking very short-term, while consumer or average Joe is expected to think very long-term. Governments are allowed to often and quite willingly go into debt and still operate, while the average person is not able to take on much debt. Therefore, if they do, then there are difficulties later on in life, such as getting mortgages or loans, and also difficulties paying off their debts that they have acquired in previous years. We understand that it's sort of pay off big debts for big government last, but pay off debts first for you and me. So at the end of the day, the pill to swallow here is you do indeed need to pay off your debts. You should pay off your debts and prioritize that. This will allow you to save. And then when it comes to saving, you'll be able to eventually build capital so you can put it into the markets with confidence. The point is that unlike the way big institutions operate, you are not in a position to do the same. So what can you do to continue to be financially responsible in your own court? You can begin with building your own funds and protecting your own savings and having good habits. So here we'll take a look at understanding your own personal finances. What is coming and going in your bank account each month is going to be top priority. When I started to look at money as a business instead of a tool for survival and nothing else, the habits surrounding my spending behavior changed drastically. For example, when you are young and hustling a few jobs, you pay off your debts to survive. You tend to think in the mindset of, I worked hard, so therefore I need to treat myself immediately after this. To make matters worse, this is a very human condition that is preyed upon by literally every company trying to tell you to buy something or sell you something. They understand very deeply when that trigger comes, what time of the month it comes, when it hits, etc. So with this example, you're working your 9 to 5, you worked really hard over the last 2 weeks, you get your paycheck has a bit of surplus on it, you have a little bit more than what you were expecting, you pay all of your bills, and you have, say, $300 left over. Person A is going to spend that money that they weren't expecting on maybe luxury goods or materials to make themselves feel better about their hard work. And mentally, they're going to say, I'm spending this because I deserve it. I worked really hard. Person B, which is the person that I hope that you will become by the end of this course, is going to say, well, I have a surplus of cash in my hands. I was not expecting this surplus. So now I'm going to take this surplus and either pay down more debts or put it into saving. We have to understand that there are algorithms inside of the markets here that are made and built to keep you spending money. We have all searched on the internet and, been talking about certain things that maybe we wanted to purchase, but we weren't sure if we were, and suddenly we have ads popping up on our phones, or we searched for something and suddenly we have ads popping up on our phones, or companies that are similar to the ones that we search for with maybe a sale price that's trying to get you. So you have to understand that the environment of consumer spending is a very, very crazy place right now. There are a lot of systems that are built to keep you spending money. So you need to make sure that you have the discipline to not do so when you come into a surplus. The art of paying yourself first. We want to be paying ourselves first. And what I mean by this is paying yourself first is the first principle and the most important as it pertains to personal finance and building capital. This could be capital that goes towards many things. Even though this is a retail trader's course, you can look at it into this way. Saving to pay down debt, saving to pay loans, so you can buy a home, saving to build for your child's future, saving to build a savings for retirement, saving to build an account to start investing with. At the end of the day, any of the above is more responsible than taking that small amount of surplus that you weren't expecting and going to buy a material good. I'm not saying don't ever buy material goods ever again. This is a portion of the economy that keeps the economy running. However, when we look at the year, say for example, you get your taxes back and you look how much you made, you could often wonder, where did it all go? Well, a lot of it probably did go to keeping up with your expenses of just being able to keep a roof over your head and put food on the table for yourself or your family. But a lot of that does go to consumer spending on goods and materials such as clothing and, maybe lavish trips to places that perhaps you could have held off on in order to keep a little bit more money in your pocket, etc. We're taking that type of capital and putting it into a savings instead. So paying yourself first means if, say, for example, you get a paycheck that is $1,000, you pay off your bills, and your bills in total is about $500. You have $500 remaining. With that $500, you decide to pay yourself $250 because you worked hard. So you should be able to pay yourself to put inside savings to have at a future date somewhere. You are sort of your own business, so you have to keep and sort of hold on to what you can. So you take $250 and you pay yourself first. And you do this every single paycheck, knowing that you'll have $500 left over to do with. You could take a larger chunk of that $500 and pay yourself first. You could start small because you know that you need to kick your spending habits, but you're not going to be able to quit cold turkey. So you take 100 of that surplus and you pay yourself first. At the end of the day, I'm teaching this because it takes capital to make capital in trading. So you have to build a fund in order to have that capital to trade with. So it's really up to you how much you want to continue to put away so you can trade with that. Regaining control and keeping control of your personal accounts. It takes time to enter markets. This is why taking $100 and tossing it at the market and losing it is a lot weaker of a decision than taking that same $100 and investing it into book and learning resources. So you can then be able to take another $100 and invest it into the markets way more confidently than you would have if you just tossed the original 100 into the markets. For me, this is how I basically built my repertoire of knowledge when I first started. We had, a surplus of cash at that point in time, the individual that I went into penny stocks with, and we decided to, instead of going to the mall to go shopping every paycheck, we decided to put that away and start learning how to trade penny stocks. So it takes capital to make capital. The first couple of months was obviously not successful at all. So instead of building up another $100 or $200 and tossing it at the market, I decided to go my own way and invest in books and knowledgeable resources. And so now I come from the mindset of, if I could teach myself again, what the first initial steps would be. The first initial step would be education and proper education, not just sort of a 10-minute video of I can teach you penny stocks in 10 minutes and you're set. These are misleading, and so after not seeing results with videos such as and being naive, going through and actually learning about economics and learning about how markets move, learn about pretty much the entire year, the quarters of the markets was basically the next step. And then after that, risk and everything else that follows after it. Technical analysis, fundamental analysis, and then building strategies. So at the end of the day, you want to gain control. You want to regain control your accounts in order to build capital, in order to save and pay off your debts, in order to invest it into the markets. So the fundamentals are sort of the raw bones of this ethos is assets and liabilities. So assets are land, home, commercial buildings, businesses, alternative streams of income. There are ways that you make money without having to spend much money. So it's money that comes back to you based off of your investments, where liabilities will be credit card debts, college debts, loans, rents, taxes, interest, car payments, home billing, mortgages. That's sort of like money extracted out of your account. So assets would be things that allow money to enter your account. Liabilities, in layman's terms, are things that would be extracted from your account. There are temporary or permanent lanes where money goes and then when it's gone, it's gone. With less people who do very well financially usually have more assets inside of their allocation than liabilities. So let's dive in a little bit deeper to the psychology of consumerism. We often look at the uber wealthy and joke about how maybe they wear the same thing, the same sort of basic t-shirt that we see the Steve Jobs of the world and the Mark Zuckerbergs of the world and the Elon Musk of the world, the same pair of jeans. Well, really, they have a good concept of consumer psychology, or the psychology of consumerism. They're not out there spending their money on material things very often. They're thinking, do I need to go to the Nike store and give Nike another $60 when I know that their company is valued at X amount? Do they really need my $60? When it comes to maybe needing gym wear, possibly going with a smaller company, promoting smaller companies within your community if you're going to do it. Materials is the one sort of thorn in people's side when it comes to being able to save. And when it comes to consumerism, there are many tools that make us want to go out and spend money. This is their job. They need to advertise. They need to tell you that you want something before you want it. They need to remind you and poke you that you still have items inside of your cart when you were just window shopping and you forgot about it. They need to put things on sale so you can be more inclined to go back to that store and grab it, etc. So when it comes to tackling this portion of your life first, my best and most sound advice would be to get clothing that is built to last instead of sort of these fast fashions that you are spending your paycheck on every single time you get paid. If this is not something that you do, then perfect. You're already inside of the right mindset, the right space in order to start building your capital so you can become an investor, become a trader. But this, specifically speaking for those who live in America, because we are a very material consumer-based society, minimalizing the things around your house as well as your wardrobe, as well as the way that you spend your money throughout the week. It could be, instead of going and spending $8 at Starbucks every morning, you take that $8 and go buy a coffee maker and a bag of coffee. 16-ounce coffee bags cost about $12 on average, and they serve an average of 30 cups of coffee. So that saves you a lot of money there. Instead of purchasing fast fashion and it's last only twice out of the wash, you could spend a little more on a quality piece of clothing that will last you a few years. Your return on investment there is much better. Therefore, you have the money to start have the money to start saving up and placing elsewhere. So don't drain yourself. Pay yourself first. Buy things that are built to last. Think about how much you spend on certain items throughout the week and figure out how you can spend less.